what role should Roth conversions play in a tax-efficient practice? And this is an excellent question. I believe in planning for this closer to year end when you know where the clients stand tax-wise. And if you are not a CPA, this is a good idea to work with your client's CPA because they're the ones that have more information on the actual tax situation, and it's another way to create a possible referral source. So when you're looking at whether a client should do a Roth conversion, I generally look at a few factors. Number one, do they have the cash to pay the tax outside of the IRA? If they're going to have to pay the tax from the IRA funds, then you're not going to really get much of a benefit from converting to Roth. Secondly, are they going to be using their IRA to fund cash flow in retirement? In that case, they're planning to use up their IRA over time, and it's likely better to just have them pay tax over time than to pay tax up front. Next, take a look at if they're planning to leave their IRA to a charity. If they're planning to leave their IRA to a charity, then the ordinary tax that would typically be due on the entire balance of the IRA, whether to you or to your heirs, is not applicable because charities don't pay tax. So it doesn't make sense for your client to pay tax and then pass it on to a charity who would not have paid tax. Finally, you want to take a look at, will the client be in a lower tax bracket later? It doesn't make sense to convert a Roth in a current year that is a high bracket year. So when you're looking at that, if all of those questions point to it's a good idea to do a Roth conversion, then you need to look at whether the client is in a lower bracket or a similar bracket to what you expect down the road. If a client is in a 0% or 15% or 10% tax bracket, I think it is almost a responsibility for you to recommend a Roth conversion. I actually think it's a liability if your client is in a 0% tax bracket and you don't bring up the possibility of converting to Roth. When the client needs to write a check to do a Roth conversion, you need to make sure the client is willing to write that check. You can do all of the calculations you want, and if the client says, I don't want to write a check to the IRS when I cannot write a check to the IRS. That's kind
Cheryl,
of a, yes?
when you say it's a liability, you mean because by not doing so, you may actually, as a fiduciary, be guilty of malpractice?
Absolutely. I mean, if you have a client in a 0% bracket where they could convert IRAs for free and never pay tax on that balance again, I think your client could conceivably have a case against you. So thanks for clarifying that, Andy. Now, I have some advisors that say, well, if I have a client in a 0% tax bracket, then I want to go for tax gain harvesting. And it's true. If they're in a 0% tax bracket or 10% or 15%, then you can actually recognize capital gains for those clients without paying tax. The issue is that I think by avoiding a capital gain tax down the road, you're saving them money at capital gains rates. If you can convert a Roth IRA at little or no tax, you're avoiding ordinary tax, not only on the current balance, but also on all future earnings. So I still believe that Roth conversion should take precedence over tax gain harvesting when you can get that 0% capital gains rates. Keep in mind, If they don't have any IRAs, then you do want to go after tax gain harvesting. And again, I think that is a risk, a liability risk to the advisor. If you have a client in a low tax bracket that could capture gains at no cost, and you don't do that, I think that's a risk. So hopefully this addresses that question. Let's go on to question number 2, which is, at what marginal rate do you personally prefer munis versus taxable bonds in a taxable account? Well, the basic answer to that is doing simple math. What is the return of the muni versus the after-tax return of a taxable bond? And you choose whatever is going to put the most money in your client's pocket. Now, I always like to look at a couple of other points when you're considering what to do with bonds. Number 1, consider location optimization. If you can locate bonds in an IRA, then those bonds producing interest income will not be taxed on a current basis. So you are able to use the higher return bonds, which are typically taxable bonds, and hold them in the IRA, as opposed to using munis in the taxable account, which essentially have a tax haircut anyway. The other reason to consider moving bonds into the IRA or using municipal bonds is looking at whether your client is subject to the investment income surtax. When they are subject to that, it essentially raises their tax rate on that interest income, so that makes avoiding tax on that very important. Question number 3 is actually a 2-part question, which is, in your practice, have you ever avoided harvesting a loss because you didn't have a suitable alternative? And if so, what subclass or class was it? There have been times when I have not harvested losses because I didn't have a suitable alternative. The reason for this is that I don't believe a temporary tax difference, meaning merely postponing tax, is worth doing if it's going to impact the long-term strategy of the portfolio. If it's a permanent difference, tax that you're never going to have to pay, I think it's okay to relax things a little bit. So let me explain that. If you have a case where you need to rebalance something, and it means you have to sell some positions that are going to generate a short-term gain, but if you wait a month, it's going to be a long-term gain, I would be inclined to wait the month and leave the portfolio slightly out of balance rather than cause the client to have to pay an extra 50% tax just because you're doing the transaction early. That extra tax between the ordinary tax and the capital gain tax will never be recovered by the client. And so if it's a permanent tax difference, again, I think it's okay to relax your strategy. If it's a temporary tax difference, I'm not going to do it. And especially because you have to be out of the position for at least 30 days. So if you sell something that you like, just to recognize the loss, and then you buy something that you think is substandard, you're going to be holding something substandard for at least 30 days. If that particular investment increases in value, then you're probably going to hold on to it longer term. And essentially what you're doing is sacrificing what you think is best for the client. Now, in terms of which particular class or subclass did this happen with in my practice, I really can't remember. I'm thinking possibly emerging markets equity, but again, that's something for each advisor to consider when doing tax loss harvesting. Our last question has to do with location optimization. And the question is, does your location optimization discipline change based on where a client is taking distributions? And this person gave an example saying, when all distributions are coming from a taxable account, do we still hold all equities there, meaning that we'll have to sell and rebuy in the IRA? When you're pulling money out of a portfolio, there will typically be ongoing transactions in order to generate the cash to do that. So there will necessarily be sales, and it's a fact of life. If holding the equities or any particular position in the taxable account means you have to sell and rebuy in the IRA, I'm okay with that. It's actually less expensive to sell in IRAs because there's no tax consequences. In my practice, we believe in creating a little pool of liquidity, and typically that is 3 to 6 months of distributions, and as that pool gets to be lower than a 3-month supply, we replenish it. Now we can also relax that a little bit based on what's happening in the market and the kind of transactions we need to do by having 3 months as a minimum. If we need to go down to 2 months or 1.5 months, strategically we can do that. So my greatest concern when I have a client that is in a drawdown phase is, again, maintaining the integrity of their investment strategy. And because location optimization can create permanent tax savings, I am more concerned about that than with having to do some minor transactions occasionally to essentially move investments from one side to the other. So hopefully that answers most of the follow-up questions that everyone had. And if you have any more questions, you can feel free to email me directly or send those requests through Advisors for Advisors, and I will try to get back to you.